The S&P 500 finished June exactly where it started, flat. That flat number hid the biggest shift in the market in 2 years. Small companies rallied. The average stock gained ground. Money moved out of the handful of giant names that have carried the index for 2 years and spread into everything else. If you only read the headline number last month, you miss the real story. And the real story matters for your retirement money. In the next 12 minutes, I'll show you the numbers under the flat line, open up our own portfolio's winners and losers by name, and walk through why two of the sharpest market voices we follow disagree about what comes next. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here is the plan for today. First, the June numbers and the rotation underneath them. Second, our portfolio, the winners and the losers with nothing hidden. Third, two holdings that test an investor's discipline in opposite ways. And fourth, the bubble question through the eyes of Nick Murray and Ed Yardeni. Start with the scoreboard. Through June 30th, the cap-weighted S&P 500 slipped slightly. The equal-weighted version, the same 500 companies each counted equally, beat it by more than 3 percentage points. Small caps led outright. That gap tells you something the headline never will. When the average stock beats the index, breadth is improving. Money moved past the largest few names and into the rest of the market. For most of the past 2 years, the action ran the other way. Narrow, top-heavy, and concentrated in a handful of technology giants. June reversed it. The year also gave us a scare. Fighting in the Middle East rattled markets, prices dropped, and the financial press ran wall-to-wall coverage. Then it faded. The S&P bottomed during the fighting and set a record by early June. I was working with a client recently who called during that stretch, ready to move a 7-figure account to cash until things calmed down. We walked through what selling in past scares would have cost him. He stayed put, and the record high arrived a few weeks later. Headlines are loud. They are also a terrible trading signal. Now to what we own. We hold businesses, and our results rarely match the index by design. Year to date, the spread inside the portfolio is wide. Advanced Micro Devices is up 171%. Accenture is down 53%. Both sit in the same account and both belong there. The full list of leaders: AMD up 171%, Taiwan Semiconductor up 58%, Interparfums up 34%, Diamondback Energy up 18%, and Alphabet up 14%. The laggards: Accenture down 53%, ServiceNow down 35%, Copart down 28%, KKR down 28%, and S&P Global down 26%. June had its own scoreboard. Interparfums gained 20% on the month, Medpace 18%, and Taiwan Semiconductor 14%. Accenture fell 34, ServiceNow 20, and Microsoft 17. A gap this wide is the reason we hold a range of businesses and rebalance once a year. Some of what we own is being rewarded right now. Other holdings are out of favor. Over time, trimming the first group to add to the second is how the discipline pays off. You will notice I named the losers with the same precision as the winners. Plenty of advisors only show you their trophies. You deserve the whole shelf. Two holdings deserve a closer look because each one tests discipline in a different way. First, the winner. AMD is up 171% this year and more than 300% over 12 months, carried by demand for the chips that train and run artificial intelligence. A position that has tripled forces a decision: add, hold, or trim. Our answer runs through the plan. When one holding grows into an outsized share of the portfolio, year-end rebalancing brings it back toward its target and moves the proceeds into businesses the market has left behind. We are keeping a good business and managing how much of your money rides on any single outcome. Second, the bargain. S&P Global is down 26% this year, while the underlying business keeps doing what it has always done: running credit ratings, indices, and market data that much of the financial world pays for on a recurring basis. Price and value are two different measurements. A lower price on a durable business is a different event from a lower price on a fragile one. What we did for a client last month shows the principle in action. We trimmed a winner that had grown past its target weight and added to two quality names trading below our estimate of their value. No forecast required, just the plan applied. Quick break before the bubble question. Every company in our portfolio has to pass one test before it earns a spot. It has to fit one of three buckets: ownership companies, monopolies, and oligopolies, or cannibal companies that steadily buy back their own shares. I made a full video breaking down that framework, and if you are serious about owning businesses for the long haul, it is the next thing to watch. The link is in the description and the pinned comment. Now, the bubble question. Everyone wants to know whether this market is 1999 all over again. Two voices we have followed for decades looked at the same facts and reached conclusions worth hearing side by side. Nick Murray's July letter, turning into the torpedo, concedes the echoes are real. The S&P trades near 21 times forward earnings. Roughly 40% of the index sits in big tech. The largest IPO on record just priced at more than 150 times sales. Murray refuses to predict the top. His counsel is older and harder. Sharp, temporary declines are the price of admission for equities' long-term returns, and their timing cannot be known. Since 1950, the S&P has fallen at least 20% 17 times, about once every 4.5 years, and still compounded at 11.6% annually over the whole span. He calls the drawdowns the toll, and the toll has always been worth paying. Ed Yardeni of Yardeni Research takes the bubble question head on. His July 4th piece, A Bubble in Bubbles, points out that in 1999, the technology sector traded near 55 times forward earnings. Today, it trades near 22, barely above the S&P's 20. The dot-com melt-up ran on fear of missing out. This market, in his words, runs on fabulous earnings momentum. S&P 500 forward earnings just set another record. Analysts expect per-share earnings up 26% this year, and 86% of companies have rising estimates. He holds a year-end target of 8,250 on the S&P. Here is the part that matches our own June numbers. Yardeni called the month's dip a rotation, with money broadening out of the largest names into small caps, the equal weight index, and cyclical groups like banks, industrials, and healthcare. That is the same broadening our portfolio lived through in June. Caution and confidence in the same breath. Expect turbulence and keep owning the businesses that have rewarded patience. Halfway through the year is the right time to check the plan against reality, and progress is bigger than your account balance. The earnings of the companies you own kept rising through June. So did the dividends they pay. There is a second measurement that never shows up on a statement: the intrinsic value of the businesses themselves. Weighting each holding, we expect the portfolio's intrinsic value to compound at roughly 22% per year over the next 3 years, about 19.5% from forward net income growth, plus a 2.3% shareholder yield from buybacks and dividends. Prices wander month to month. That engine runs underneath them, and the engine is what we actually bought. We have roughly 6 months until year-end rebalancing, the once-a-year step that trims what has run hot and adds to what has lagged. If your goals have not changed, your plan should not change either. Anyone whose circumstances have shifted should say so now, while there is still time to adjust before year-end. One idea to carry out the door: prices wander, value compounds. Own the engine and let the quote do what it does. If you got value from this June review, you are going to want this one right here, where I break down the 3 buckets framework: ownership companies, monopolies and oligopolies, and cannibal companies, the test every business has to pass before it earns a single dollar of our clients' money.